According to recent research, 40 million Americans are carrying student loan debt. That's a huge number because the vast majority of those people are young and trying to get a start. Most people consider owning a home part of that start. So how does student loan debt affect your ability to get a mortgage? In a few ways, and it's different for all kinds of loan programs. I'm going to warn you, this video gets pretty technical because it has to in order to cover everything. So here goes. Government loan programs and student loan debt. As usual, the ideas behind loan qualification aren't as complicated as they seem. The main goal is to make sure the borrower will have the ability to repay the loan. So, of course, lenders are going to have to look into the amount of money that's going out every month for student loans. The way they look at it depends on the program, however. We're going to cover government loans here because they're a little easier to package together. We'll talk about conventional loans a little later. Just to start, there are a few terms to be familiar with. Debt-to-income ratios, or DTI, are represented by a percentage that indicates how much of your monthly income is owed in debt. So if you make $1,000 a month and you owe $500 a month in car payments, credit cards, and student loans, you have a 50% debt-to-income ratio. And then there's deferment for student loans. This means you aren't required to make payments on the loan for a set period of time. If your loan is in deferment, this can make it easier to get a mortgage under very specific circumstances, which we'll go into. Okay, so with terms out of the way, let's start with FHA, the most common type of government-backed loan. FHA counts your student loan payment whether the loan is in deferment or not. If you've been making payments, this amount will show up on your credit report, and that's what is calculated to get your debt to income. If the payment on the report is zero for any reason, the lender will use 2% of the balance of your student loans to determine a payment. VA loans, which are available to those who have served our country, do allow you to consider deferments, but only under specific circumstances. Basically, as long as payments will be due any time in the next 12 months, lenders have to count that payment in your debt-to-income ratio. If you can provide evidence that no payments are due for the next 12 months, then they can leave those out, which may help in qualifying for the loan. USDA loans get a little more complicated, but only because of an exception. In general, lenders have to use the greater of two amounts, either the payment on the credit report or 1% of the student loan balance. There is an exception though. The monthly payment on the credit report can be used, even if it's lower than 1%, only if it can be verified as a fixed payment. This means there is no room in the student loan agreement for that payment to change. So if you have an income-based repayment, graduated, adjustable, or deferred repayments in place, you don't qualify for this exception. So here's a handy chart I'll provide a link to in the description of the video if you want a quick reference. If you're looking for a loan and you have student debt, or if you know someone who is, I hope this can help to arm you with the knowledge of your options going in. It is certainly possible to get a mortgage, even with student loan debt. There are just some things to keep in mind. As always, if you have any questions, please leave a comment below or email us directly so we can find someone to get in touch. And if you found this video informative, please click the like and subscribe buttons so you can get notified of our weekly updates. Thanks for watching.